Good morning, good afternoon, good evening, everyone, depending on which part of the globe you're at. This is the broadcast, the CBDC broadcast session 24 from FNA. Today we're going to have Project Helvetia, number 3 or the third one, settling tokenized assets with a wholesale CBDC. Let's wait for a couple, perhaps 1 minute, and we'll start. Thank you. In the meantime, while everyone joins and sits comfortably, I'm going to go through the agenda for today. So we're going to start with an introduction on housekeeping. 5 minutes we're going to allocate to that. Then we're going to have about 45 minutes with the main session, in which we're going to have Thomas Moser, alternate member of the governing board of the Swiss National Bank, and David Newns, heads of SIX Digital Exchange. After these 40 or 45 minutes, we're going to have a session of question and answers that will take us about 10 minutes. So for those question and answers, please submit those questions via the Q&A widget that you will find in our conference platform. So without further ado, let's start. First of all, thank you, Thomas and David, for accepting our invitation to talk about Project Helvetia III. Which, as I already mentioned, is about settling tokenized assets, in this case bonds, with a wholesale CBDC denominated in Swiss francs. Before we start, we always give like a couple of minutes for the co-speakers to present themselves and to make the disclaimers they find suitable for this session. Thomas, thank you for joining us.
Thank you very much, Carlos. So you want me to introduce myself already?
Yeah, please.
Sure.
Yeah.
So as you pointed out, I'm an alternate member of the governing board of the Swiss National Bank. Now, what does that mean? That means that we have a very small board at the Swiss National Bank. It's 3 people. Each of one has an alternate. Recently, we actually have added a second and possibly of a second alternate. But I'm in this position since 2010. So I'm part of the enlarged government board, but I'm also deputy head of one of the 3 departments of the Swiss National Bank. So until 2018, from 2010 to 2018, I was deputy head in the department that has mainly the economics, statistics part. But since 2018, I'm in the department and deputy head of the department that has the markets and banking operations and IT. So that's where I'm coming closer to the topics we talk about today. Before joining the Swiss National Bank, I was an executive director at the IMF in Washington, D.C. Let me leave it at that.
Thank you, Thomas. That was a very interesting explanation, because I also had the question of what alternate member of a governing board of a central bank meant. Thank you very much for that. David, your turn. Thank you for joining us.
It's a pleasure to be here, Carlos. Thank you for having me. So I'm David Newns. I'm the head of SIX Digital Exchange, which is indeed the world's first fully regulated financial markets infrastructure. That's an exchange and CSD based on blockchain technology. Prior to joining SIX Digital Exchange, which was in 2021, I was 14 years plus at State Street, and before that at MicroStrategy. So since we went live in about around when I joined in November of 21, we've been issuing at this point almost a billion francs worth of bonds on the platform. At the same time as building out SIX Digital Exchange, I'm also the chairman of AsiaNext, which is a institutional grade cryptocurrency, cash and derivatives trading platform in Singapore. That's a joint venture with SBI Digital Asset Holding. Now, both of these ventures, SIX Digital Exchange and AsiaNext, I think are manifestations of where we are in the adoption of digital assets more broadly, because these are both particularly directed specifically at providing infrastructure for institutional activity within a digital asset space and supporting that in a regulated, transparent and efficient fashion on institutional grade technology.
Thank you, David. That's a great introduction. Having worked at MicroStrategy, I think that gives you a very broad and very comprehensive view of many things about tokenized assets, right? That
was a long time ago, I have to say. And before, I think before Bitcoin was even a glint in Satoshi's eye, to be honest. But it's just, it's kind of an interesting thing that the world has kind of come full circle, and now I read about my alumni on a daily basis in this particular space.
That's interesting. Thank you, David. So before we start, I'm going to make a very brief introduction that has to do with why is this important? Why are we going to talk about this? And the thing that we have heard everywhere that retail CBDCs and wholesale CBDCs are coming our way. They're getting each time closer, and there are several questions about them. And we're going to focus on wholesale CBDC today. And perhaps within the realm of wholesale CBDC, we're going to focus on something which it's very interesting as well, which is liquidity management. And as the wholesale CBDC that we're going to see today, it's about allowing financial institutions to settle tokenized asset transactions with a wholesale CBDC. Then there is also obviously a question about how the liquidity, the cash leg of the transactions is affected by doing this. So what we are going to discuss today with the Swiss National Bank and SIX Group is about Project Helvetia, phase 3, in which, as I already mentioned, there is the issuance of a live wholesale CBDC for commercial banks to settle tokenized bond transactions. Therefore, that's what we're here today for. So let's start. And first, we already have, my usual first question is about how would you describe your role and involvement in Project Helvetia? You already touched several points, but I think that there are several things missing. So could you please, Thomas first, David second, to tell us a little bit more about your role and involvement in Project Helvetia phase 3?
Yes, thank you. So I was one of the initiators of the Project Helvetia, and that goes back to probably 2019. And as you mentioned, we have these 3 stages. So in the phase Helvetia 1, it was really or maybe I should even take a step back. I think we had a very good situation as a Swiss National Bank that we had already SDX in Switzerland, this regulated, supervised financial market infrastructures for digital assets. So for us, the question was like, if this really becomes the future financial market infrastructure, if it becomes important, we probably want trades there to be settled in central bank money. And so the question was like, how would we do that? And that really led then to Helvetia stage 1 in 2020, that we just wanted to figure out how does it work if we want to provide wholesale CBDC on such a platform. And we were very lucky to work together with SDX because this is a third-party platform. It's not our own platform. But it's a platform that already existed where you had real actors, real transactions. So it was never just a research project because we had the real thing right in front of us. And for us, the question then in phase 1 was, how is it to run a node on this platform? What does it mean to issue a wholesale CBDC? So all these technical, but also some of the legal issues were dealt with in phase 1, and that was 2020. And then in 21 and 22, we went a step further and got involved with the banks. And there in phase 2, the goal was to have really end-to-end connectivity, meaning going into the core banking system of our own system and in the core banking systems of the commercial banks and see how a wholesale CBDC flow goes from core banking system to core banking system. And that was very interesting, and we learned a lot because we had real banks on the other side, also not a research project. We had some Swiss banks, Credit Suisse, UBS, when they were still 2 different banks. We had some international banks. We had Goldman Sachs there. We had Citi, and some also a smaller Swiss national bank, Hypothekar Bank Lenzburg. And now phase 3, the important thing here is this is not a test anymore. This is in a production environment, not in a test environment. So these are real transactions. And interestingly, you learn a lot more if you do it in a production environment. I hear that from the banks. I hear that from our own people. And overall, these 3 phases, apart from helping initiating the whole project, I was overseeing it at the steering committee level. and always kind of making people to do a little more and go a step further. So that's how I would describe my role.
That's a great description of the project, besides your role in the project. Thank you. David.
So yeah, the role of SDX in this, I think Thomas articulated it pretty well in terms of how the SMB sees SDX and the value that we can bring to the sort of the Swiss financial center. So fundamentally, SDX's strategic focus is to enable the digital transformation journey for the Swiss financial center, and that's been done in partnership with banks, financial institutions, and the Swiss National Bank. And from our perspective, the SDX Digital FMI product set around our exchange and post-trade services is kind of the core of what is required to power that digital asset ecosystem that's foundational for the future generation of the Swiss digital financial center here in Switzerland. So we see our role as being as assisting and enabling this evolution, because unlike sort of other participants in the marketplace, we're the sort of neutral non-market participant, so a neutral third party that isn't a market participant, that can be an orchestration and coordination vehicle that, as Thomas says, is in production, is always there, is always on, because that's the whole point about FMI, is that we are, we're ready and able to carry out activities rather than be a sort of a single project, proof of concept kind of science project where you put something together for the purposes of proving out something. I think in this particular, our role is very different. We're here enabling that migration and enabling the evolution of the entire space by being an always on, always building, and always sort of moving forwards as we add the additional sort of foundational components that are required to actually achieve that evolution. And for us, Wholesale CBDC is a critical foundational piece to actually enable that transformation, enable that move into tokenization and blockchain-based capital markets infrastructure. So that's the role that we see. I think fundamentally a vehicle for transformation, and that has to have all these attributes. It needs to be regulated, it needs to be in production, it needs to be always on, it needs to be neutral, etc., etc.
I think I cannot stress enough how important the existence of an infrastructure that is already settling or clearing and settling the digital assets is for piloting, for making a pilot, a real pilot, and the production environment at the end, like in phase 3, about wholesale CBDC and tokenized assets. I mean, I think it's a unique case in the sense that you already have what is needed to make it work on production environment. I think that it's a unique case, and we have at FNA we have been working with several clients about wholesale CBDCs, and that's one of the main questions. I mean, what are the markets going to be like? What transactions are going to go there? What is going to migrate? But you already have like part of the question, and that's great, and that's why this Helvetia phase 3 is so important. So let's start with some questions about the project itself. And perhaps the first question I had when I read about the project is that I've heard or I read in from several sources that several banks in the wholesale CBDC pilot in India complain about higher liquidity demands due to atomic settlement. And that's an expected outcome because atomic settlement as a pure 100% RTGS should be very liquidity demanding. Was this the case in Project Helvetia phase 3 as it was into the production? Thomas.
Yeah, no, that's a good point. Actually, that topic came up the first time already in phase 2, because that's when banks realized that they have to pre-fund the trades, and that could become an issue. But I think it's important and that cost us, of course, like others, to look deeper into this issue. And maybe just at the conceptual level, I think it's important to point out that atomic settlement doesn't necessarily mean instant settlement. So we have this this blog contribution that Antoine Martin did and Benjamin Müller at the Federal Reserve Liberty Street blog, where they actually make this differentiation between instant settlement, meaning that the trading and the settlement happen at the same time, and simultaneous settlement, which means that both sides, both legs happen at the same time. And actually atomic settlement should only mean the second, that both legs take place at the same time. But that's a concept that you also have with delivery versus payment. So you can, the way that that most DLTs are set up, that you have instant settlement, but that's not absolutely necessary. And I think it will be very good to look into these possibilities to have only simultaneous settlement, but maybe have the trading and the settlement at different times. I think that there's still a lot to explore here. Now, more specifically in the phase 3, but David maybe wants to and certainly even correct or add to that. That was not really an issue because especially secondary market activity is very limited. So we had really seen these bond issuances. We have seen so far in this phase 4 bond issuances, each one around 100 million Swiss francs, 100 million US dollars. And that was very plannable because the way we set it up is that the banks, they have a technical account in the RTGS. And if they want to get wholesale CBDC, they move their money from the account in the RTGS into the technical account in the RTGS, and then can exchange this with us into wholesale. So we issue then the wholesale CBDC for them on the SDX platform. And basically because they had to tell us before if they wanted to issue a bond with wholesale CBDC, you know, everything was very plannable. And with limited secondary market transactions, that liquidity issue has not come up, at least so far in phase 3. I don't know, maybe David, you want to add to that? You're closer to the trading.
I would echo your comments though, Thomas, in that is that the activities that we've been focusing on here, because these bonds are instruments that are typically purchased and held by the investor. They're not bonds that transact in the secondary market, particularly significantly involved in terms of volumes. That doesn't mean that this isn't something that we need to address going forward. So in the future, absolutely, I think mechanisms to provide different settlement constructs are going to be important. That the secondary market activity will not, I don't think, will be sustained through a pre-funding, because there's not enough liquidity in the planet to actually support that sort of the activity that we see today in the secondary market if everything needs to be pre-funded. But that's not something that is beyond our ability to actually provide in the future. So we're exploring a number of sort of replications of existing settlement structures, as well as the leveraging of blockchain to do new and novel ways to actually provide functionality in a particular area. So I mean, there may be ways that we can to new angles around and again sort of the liquidity savings mechanisms that I know that you've been sort of looking at yourself, Carlos. This is an area that I think that there could be opportunity for DLT technology to be applied, because it makes it relatively easier to compose multiple transactions within the construct of a blockchain or a DLT.
And I think, David, you just answered my next question, so I'm going to skip it, but I'm going just to give you like a wrap up about that topic, which is that, and that also surfaced when we had this broadcast or a similar broadcast with CLS, in the sense that atomic settlement doesn't mean that you have to settle everything immediately. I mean, it's more about the simultaneous settlement of things. So at the end, if you allow the transactions to have 5 minutes, 10 minutes, 1 hour, or 2 hours, you can apply bespoke liquidity saving mechanisms. You can have resequencing, you can have queuing and other types of liquidity saving mechanisms, so that those wholesale markets that we know that profit from netting and from other liquidity saving mechanisms, still can profit from them. But so that's important to have in mind, and not to think that atomic settlement means that everything is going to be run like an RTGS, 100% RTGS system in which everything is going to be settled immediately. So David, you already answered my question, and Thomas, you also made a point about that. So I'm going to skip that one, and I'm going to the next question. Which has to do with something about also the another source of liquidity, because in all payment systems you have several sources of liquidity: the initial balance, the recycling of liquidity, and the third one, which is the one I'm going to go to now, which has to do with liquidity sources from the central bank. In this case, what types of intraday liquidity facilities did or did not the Swiss National Bank provide the participants to support the operations with Wholesale CBDC?
So in this stage, I think it's important to point out that all the participants on SDX, they also have an account in the RTGS. So basically, what was possible or is possible for these banks, they can actually move between the SDX and the RTGS. So they could use the standing facilities that we have, the regular ones in the RTGS. They could use it there and then move liquidity to the SDX, at least in theory. I mean, it hasn't been used yet. But so in that sense, they also have the normal intraday facilities through repos, for instance. They could do it in the traditional world and then move it to the new world. Of course, if we assume in the future we're in the new world only, we have to provide the same facilities in the new world. And that's actually one thing we will also look into during the Helvetia 3, but only in a test environment. So we will do some repo transactions entirely on SDX, but that's only in a test environment, not in a productive environment. But we will certainly report about those outcomes once we come out with the report after this Helvetia 3 study. And just one thing I wanted to add on the liquidity savings mechanism you have been working on, Carlos. I think that's also a very interesting avenue. We have actually a project in the BIS Innovation Hub Swiss Center. That's called Project Titus, and I think the report should come out within the next few weeks or months, where we also looked into two different type of liquidity savings mechanism, one machine learning based and the other one agent based modeling for auctions. So I think these are all very interesting topics to look into.
Thank you, Thomas. That's great to know. I mean, about this Project Titus, we will be very attentive, and most likely we will have you talking about that. I don't know if in the CBDC broadcast, but most likely in the FMI broadcast or the payments broadcast, which is perhaps more related to that. Going a little bit back to what you just described about liquidity access, I was wondering, and this is a question that we often find when discussing Wholesale CBDC, is about if you're going to, I mean, one of the perhaps defining features of Wholesale CBDC is 24/7 operations, is the ability or the likelihood that some new non-banking financial institutions will be able to access Wholesale CBDC, even if they don't have access to the RTGS accounts or our reserves at the central bank. So are those, as you perfectly explained, that those which were in phase 3 of Helvetia, they already have an account on the RTGS and they can request a repo and move the liquidity to the Wholesale CBDC platform. What could happen if, for instance, let's say that you, in the Wholesale CBDC system, you allowed a non-bank to enter the system? Do you think that central banks, I'm not going to ask directly if the Swiss National Bank is going to grant repos to those kind of institutions, but do you think that central banks are going to allow financial institutions, new entrants to the Wholesale CBDC, to access intraday liquidity facilities from central banks?
I mean, that's a very good question and a very relevant question. I mean, we have also, even in the traditional world, there's a big discussion like who gets access to the central bank balance sheet. And in Switzerland, we have been relatively open to give access. So also we have a lot of foreign institutions that have access to our balance sheet, and we have fintech institutions. But I think that's an ongoing active discussion. And then if you go one step further in terms of the liquidity provision, I think that needs to follow. I know that, I mean, in Bank of England has been actively talking about these issues. We have not, so we haven't really been forced to address this issue at this stage. I mean, more in terms of access, because the Swiss market is so small. And actually, we have always benefited from especially foreign institutions participating in the Swiss money market. That's why we had a relatively liberal access policy. But I think these questions are becoming more and more relevant. And then if you move into the DLT world, I guess even more relevant. We have some banks especially that ask that we should broaden access to wholesale CBDC, but that has just not been in the scope of the current stage.
Thank you, Thomas, for that. Let's go to the next question, which is the settlement in this pilot used tokenized central bank money, Swiss francs, in tokenized form of Swiss francs. If the wholesale CBDC runs in tandem with the RTGS system, which is what actually occurred, do you think this will cause liquidity fragmentation, which is one of the main questions that wholesale CBDC put into production has raised? David?
Well, I think given the structure, I think something that was identified very early on in the process, that the wholesale CBDC platform complements rather than replaces the RTGS system. So as a result, it unavoidably entails some fragmentation of liquidity, but that means that it's absolutely critical that there's seamless interoperability between the wholesale CBDC issuance process and the RTGS platform. And that's very much which we have in place with Helvetia 3. So we have real-time one-to-one transfers with zero friction between the RTGS system and SDX's tokenization as wholesale CBDC. I think in the future, there'll also need to be a seamless interoperability between the wholesale CBDC SDX platform and future DLT-based applications and ledgers that also need to use wholesale CBDC. So from that perspective, the directive, I think, emphasizes the criticality of standardization or standards, in terms of cross-ledger protocols and standards around tokens as well. For this to actually work effectively, I think that needs to be very much in place and something that we're thinking about today, because as we sort of contemplate what the future structure needs to be to actually support this more comprehensively.
Thank you, David. Thomas?
Yeah, no, absolutely. Fully agree with what David said. I could add maybe that's also why, or not the only reason, but one of the reasons why you have some advocates to a different model, not a wholesale CBDC, but linking RTGS basically to a DLT digital asset platform. That's something we have looked at already in Helvetia phase 1. Just technically, how would you just link the RTGS to the SDX platform? It works as well. I mean, but you don't get a lot of the advantages that you have from DLT. But it's something we are also looking into as an alternative model. But as I said, I mean, if you do not have then the money and the assets on the same platform, you lose a lot of the possible advantages and real advantages. But it's clearly a model that also the ECB is looking into. Bundesbank has been advocating it, and we are also looking at that.
Just to get everything clear, then there is no balance in wholesale CBDC, but the financial institutions or the banks in this case will go to the RTGS, convert it, and they will use it, but there is no initial balance.
You would synchronize the two platforms. Basically, the settlement would take place in the old world in the accounts of the RTGS on the cash side, and on the security side, you would have it tokenized.
So it's exactly what one paper that I read from the ECB has called like the trigger solution,
correct,
which is
correct.
Okay. Yeah. So I think that makes liquidity fragmentation very unlikely because everything is in the same silo, in the same only one silo. So there is no fragmentation at the end.
Correct. But you do not have all the assets on the same platform, which is one of the promises of DLT.
Exactly. David, you already said something about this, but there were like some lessons that we can have about how could the coordination of liquidity across the wholesale CBDC rail, SIC, and the SDX tokenization platform?
Yeah, I think that first of all, it's worth noting that that SDX is the tokenization platform for the CBDC component. So there's just the interbank clearing, the SIC and platform, the RTGS platform, and SDX. And actually referring back to your previous the previous question around trigger mechanism versus wholesale CBDC, I think it's and as Thomas pointed out as well, what you end up with there is you might not have liquidity fragmentation. To your point, Carlos, what you do get is you now have taken the settlement asset off chain, and you don't have therefore the benefits of being able to do some of the functionality opportunities you get with blockchain around specifically around composability, because you have not now got both assets, both the cash and the security or whatever investment asset on chain, and that then limits the blockchain. I think what you'd end up with is it would sort of suffice for the narrow use sets, the use cases that we're currently using to explore this space. But what you'd end up with is in the future, you'd want to bring cash on chain inevitably, because you'd want to then realize the benefits of blockchain and DLT technology, which only happens if you have both the settlement asset and the investment asset on the same ledger. So just to sort of point that out. But in terms of the sort of coordination of liquidity across SDX and SIC, so you've got you have with SDX now the situation where the Swiss National Bank is onboarded as a member and runs a node on our on the private permissioned ledger that SDX is responsible for. So we're responsible for that network. The Swiss National Bank is a node on that network, and they themselves as operators of that node are issuing wholesale CBDC to participants on the SDX platform, so on the network. So, and that's the sort of how the architecture hangs together. Then I think again back to the sort of the interoperability that we see and how sort of that coordination of liquidity is working. So at the payment level between the interbank clearing platform and SDX, so we have interoperability to be able to move Swiss francs backwards and forth between those two forms in seconds, between the tokenized and detokenized. So tokenized CBDC, detokenized CBDC. And then at the securities and CSD level, between sort of SDX, the Swiss Digital Exchange, CSD, and SIS, so the traditional infrastructure, we've also got the ability to do seamless movement backwards and forwards there too. So we can settle DVP securities between an SDX member, so someone who's on the digital exchange, and an SIS member. And within Helvetia 3, those are referred to as type 2 transactions. So we can actually bridge the entire chain from the wholesale CBDC supported SDX digital world through this bridge into the traditional infrastructure where you're ultimately settling in traditional central bank money. So we have interoperability at the SIC and SDX level for detokenization, tokenization, and CBDC, but at the securities level, we also have that interoperability between SDX and the traditional infrastructure. And I think those both are very important. And the second one being important for the purposes of the migration of the marketplace from the traditional infrastructure onto digital. There's going to be quite a significant amount of time where we have to run these infrastructures side by side, and there'll need to be interoperability between the two to actually ensure that we don't sort of limit the benefits of the digital that it can also sort of see into the traditional world.
Thank you, David. Very, very interesting to hear that. Let's go to the next one, which has to do with one of the perhaps defining features of wholesale CBDCs and retail CBDCs as well, if they're put into a DLT or else, which is programmability. In retail CBDC, we have heard from many central banks and many people or experts that programmable money in retail CBDC could be something very difficult to manage because of anonymity, privacy, and some other topics. But in wholesale CBDC, it sounds like it should be there, that it could have a lot of advantages for this clearing and settlement of transactions. Is there or were there any smart contract applications that were promising when you were running this project? Thomas.
So this is the holy grail of DLT. No, I think smart contracts have not been within the scope yet of our project, especially not on the money side. But I fully agree with you. I mean, it's a politically very sensitive topic when it comes to retail CBDC, but it should clearly be possible on the wholesale CBDC side. I mean, so interestingly, when I talk to so far in this phase 3, the bond issuers have been cantons and cities. I haven't seen any corporations yet issue a bond, and I have been talking to treasurers from corporations asking, like, what would it take for you to issue a bond on SDX? And usually they say, you know, it would be cool if the corporate actions would be automated, but that would, I guess, be on the asset side. But I guess they would really benefit from smart contracts that could make their life easier and pay the dividends, pay the interests, whatever is needed. So I think that might be an avenue to look into going forward. But so far, we ourselves have not been looking at that seriously. I mean, we have one project that looks at possibilities to do monetary policy with smart contracts, but that's really at the not even at the test, it's at the research stage, and that might become a topic in the future. But so far, we haven't been there yet.
Thank you, Thomas. David.
Yeah, so we leverage smart contracts quite substantially already today within SDX, and one of the obvious, there's lots of areas around automation is something that we've provided functionality around already. The most obvious one in fixed income is going to be the coupon payments. So that's already automated on SDX. Not particularly challenging to do. And going forwards, I think that that things like multilateral netting, so processing one transaction that involves more than two parties, I think that's those sort of opportunities are kind of again worth exploring, and then potential sort of areas that we think we could again address liquidity, so liquidity saving opportunities, so processing multiple transactions together in one single step. So where multiple transactions could be several DBP transactions from market participants. So I think that those areas are things that we think that we could provide benefits leveraging smart contracts within. And then generally, as Thomas mentions, more corporate actions or automation is something that where smart contract clearly lends themselves. I think it's worth noting that I don't think this area is quite as exciting, the whole automation of corporate actions, as I think some participants or some pundits would have us led to believe, because it's quite an efficient set of post-trade processes or asset lifecycle management processes already. When corporate actions tend to kind of go wrong, it normally is because there's something rather bespoke about the set of corporate actions that we're talking about, because a vast amount of activities are already STP'd in the context of capital markets today. So as with a lot of these technological advances, the functionality that you get around programmability, I think, is going to lead to opportunities that we can't currently imagine because of the sort of the limitations of our imagination, in the same way that when you first started talking about smartphones, you wouldn't have imagined for a moment the sort of activities that we now conduct on a daily basis and how it fits into your life. And I think it's not glib to say we can't imagine what the innovations are going to be, because I can point to 95% of the activities that have resulted that are the result of innovation in technology are ones that we did not imagine when we first started looking at that technology.
That's very interesting, David, because often it is very often that I think that there are many things that programmability on a DLT can also be delivered programmability with a central solution. I mean, there are not. I would say that there are not many things that a DLT about programmability can do, and that a central solution can't. But I agree that perhaps the thing that we have not come up with yet. I mean, the things that are about to be invented or envisaged. I think that those are the things that perhaps will profit the most from programmability. So I agree on that. The last question before we are very close to jumping to the question and answers from to the public. It's always we always include like forecasting or futurologist kind of question, in the sense that how do you see the things in the near future? So the question here is, looking 5 years into the future, how do you see large value payment ecosystem working? Are they going to be RTGS based still, wholesale CBDC based? Are they going to run in tandem? Is it going to be, what kind of architecture for the large value payment system do you see? Thomas.
Yeah, no, that's a good question. My guess would be that we will see them both running in parallel, just because it takes a while for building up this new world of financial infrastructure. So I would assume that I mean, I believe there is really potential in DLT based infrastructure, financial market infrastructure, but I think it will take time to materialize, also for banks, and especially all banks, to switch. Even if you have the large banks switching over to DLT, I think we will still see some smaller banks relying on RTGS. So I would expect for quite some time we will see them run in parallel, and that's, I think, important to consider when we go forward in designing how those two worlds actually work together.
David.
Yeah, my view is that 5 years is very much the short term, and therefore we're talking about that whole, we tend to overestimate the impact of technology in the short term and underestimate the effect in the long run. I think therefore in 5 years time, I expect that we'll be running these different solutions in tandem. So wholesale CBDC alongside of RTGS. And I think actually the time it's going to take to migrate capital market infrastructure to blockchain technology in a really comprehensive, so the majority of activity, we're measuring that's more than a decade plus. I think that the impact is just going to be enormous, but you've got to be looking at that sort of time horizon rather than expecting it to happen in the next 5 years.
Thank you, David. So we're talking about 2 decades at least, and that's very interesting, and we'll be attentive to that. Thank you very much. So David, Thomas, thank you very much for joining us to have this very interesting and joyful discussion. Now I'm going to give you several questions that we have received from the public. Perhaps I'll start with a very those kind of questions which are so simple that they are very complex, which is, how are tokenized Swiss francs different from non-tokenized Swiss francs? Aren't they both digital already?
That is right. They're both digital, but one is on a DLT and the other is not on a DLT. So all the things that you can do on a distributed ledger technology is possible with the tokenized Swiss franc. I would frame it like that. But it's a good question. I think that's also why it's very confusing talking about central bank digital money, because it's true, we have already digital money. We do not have central bank tokenized money yet.
I think that it does highlight one of the challenges that we have in this space, which is there has been a historic incredible lack of precision around the vocabulary that gets used and we end up by confusing everyone, because you can have two people who use the same nomenclature who end up who think they're talking about completely different things. And I feel that that's something else that will characterize the phase that we're in now, is much more precision around taxonomy. I mean, it might sound incredibly boring, but it would add an incredible amount of efficiency to conversations and to projects if we can just agree on the terminology that we're using. And right now, there has been a proliferation of terminology specifically around money. We have stable coins, deposit tokens, tokenized deposits. I mean, that's crazy, right? You have deposit tokens and tokenized deposits meaning different things. You have security tokens, you have tokenized securities. So it's going to be, I think, really helpful to really sort of drill down on exactly what we mean, so that again, when it comes to things like interoperability, actually building systems, we can actually build something that we're all agreed upon when it comes to the underlying terminology.
And if you ask a computer scientist what a token is, then you get again into a different type of problem, because there are very different definitions of what the token is.
Every time that I have like some concern or doubt about a concept, I always go to the BIS glossary of payments glossary. But if I'm not wrong, that's like 2013 or older than that. So I think that an update with all these terms could make sense. That could be a very nice project to suggest or to make, let's say. Next question is a very interesting one, which is, what is the advantage of having both the settlement asset and the investment asset on the same blockchain? What if there are multiple blockchains or DLT platforms, which is going to be the most probable case?
Yeah, good point. I mean, there will probably be different blockchains that need to be interoperable, but I think in the sense to have here, right now, if you look at the traditional settlement, but David is in a better position to lead us through that. But basically, you have everything on 4 different platforms. So you have a trading, you have a clearing, then you have the settlement of the securities, and then you have the settlement of the cash. You have 4 different platforms. You need to synchronize them all, and you have 4 different views. Basically, also back office operations with different data sets. So I just think, at least in my mind, it seems obvious that if you put everything on the same platform and have one view, and you know where the money is, you know where the securities are at any time, and you don't need to synchronize these different platforms, that there should be an efficiency gain to be had from that. So that's one thing. And then the other thing is, I think if you have money and securities and whatever else you want to tokenize on the same platform, I think you can come up with very new concepts and ideas, a little bit like what we see on Ethereum with the composability, that suddenly you can add and combine things that you get with already existing assets, just because they're all tokenized and then also programmable, and on the same platform, new things can come into existence that we haven't even thought about yet. So that's how I would answer that.
Yeah, I would agree completely. I think it's important to recognize or to see that what we have with blockchain DLT, which aren't completely interoperable, they're not swappable concepts. They're obviously different things. But the notion of our DLT as being a state machine. So everyone is able to determine at any one time and agree on what the state of the machine is. And that means, and the machine needs to, and some of the components of the machine, the 2 components we're talking about here, are the investment token and the settlement token. If everyone can agree on the state of who holds what in terms of investment tokens and who holds what in terms of settlement tokens, then that enables the programmability that we're talking about, that Thomas is alluding to, and therefore the subsequent applications that you can then drive off of that. And that means that you can, instead of having to sort of reconcile to determine the state of various aspects of a value chain, you have a snapshot which is the truth right now of the state of the system, and that means you can go right. I can instantaneously prove that I hold this particular asset, therefore, and then also immobilize that asset for the purposes of, say, collateralization. So you can do instantaneous pledging, and therefore from the back of that you can then you can build up sort of loan products that don't exist today, because you don't have that ability of having 100% confidence of the nature of the state of the world, of reality, which you get from having both the assets on the same blockchain. And then to the point about interoperability, yes, you also need to be able to bridge those blockchains to other blockchains, so that you can have that view across blockchains, and that's going to be a vital requirement for this infrastructure to really, again, be sort of enable the opportunities that are promised from the technology. For that to be enabled, we need interoperability as well, so that you can traverse across blockchains, because just having DLTs in silos is not going to enable us to do what we actually are wanting to do in terms of this technology overall. It can't just be sitting inside, behind. Otherwise, you just created something that's very similar to what you have today.
Thank you, David. We're going to have a couple of very quick questions. So the first one is, what is your viewpoint related to the interoperability between blockchains? Is this a pain point for adoption?
From my perspective, it is absolutely, and we've seen within DeFi, as Thomas sort of mentioned, which I think is a really interesting laboratory from the perspective of wholesale and regulated markets. We're going to look at DeFi as being sort of a space that is trying things out in a world where it's obviously it takes rather higher risks than we would ever consider doing within regulated marketplaces. You can see that the challenges associated with interoperability and actually trying to bridge blockchains, that's where a vast amount of exploits within DeFi are occurring, and literally on an annual basis, billions of dollars worth of digital assets have been stolen on bridges. So it's clearly an area of vulnerability, and something that needs to be really needs to be addressed as we try and adopt the technology within the capital market space, because you can't afford to lose any asset of any value in a capital market space, where there seems to be some tolerance around losing quite significant amounts of value within the DeFi space. So, and I think that's going to be a major hampering of adoption until that is resolved. And it's a very tricky question. There's lots of activity going on in that particular area, where technology innovation is occurring to try and address some of the sort of fundamental challenges around interoperability.
I have two questions which I'm going to merge into just one, which is, were there any cyber resilience and scaling concerns during the project?
Concerns always from a central bank point of view, but I guess that's that's a concern we have with everything IT we do. But specifically in it, given that SDX was already live, already in production, just not with the wholesale CBDC, but with their own stablecoin, we did not additionally look into that. But I don't know, David, do you want to take that up?
Well, it's always being a regulated. I think one of the aspects of being regulated financial market infrastructure that sort of comes with that, with our licenses, and is an expectation that we achieve a certain bar when it comes to the control environment within SDX, and cybersecurity being one clear critical aspect of that. It's worth noting that we are a private permissioned DLT rather than we run on public chain, which means that we have a somewhat of a different sort of structure than or certainly a different position than if we were trying to run this experiment on public chain, which I would go back to my comments previously about the vulnerability that we see in DeFi and around things like bridges. But absolutely, I think that what you get with regulated licensed entities in this space is an expectation around the quality and robustness of the control environment, and the risk environments that we have to achieve to actually both get and then maintain our licenses.
Good, David, Thomas. That's a wrap. Thank you very much for joining us today. It was a very interesting and lively discussion. I am sure that we're going to have you in one of our broadcasts very soon. So this is the end of the 24th session of the CBDC broadcast. So I think that we can close now. Thank you very much for joining us. Just for you to have some information about the upcoming broadcast, we're going to have another one in the month of April, the 30th of April. We're going to have the CBDC broadcast number 25, in which we're going to discuss VATM, enabled seamless CBDC adoption. And on the 15th of May, we're going to have a broadcast devoted to consumer fraud and scams. And that's a new type of broadcast that we're launching here at FNA. So that's one I am sure that you should attend to. So Thomas, David, thank you very much for joining. Everyone who attended, we're very pleased to see you here. Thank you, and see you next time. Have a nice day, everyone.
Thanks.
Thank you, Carlos.